Why does money hold value? Who decides how much money circulates? These questions lead us to powerful institutions known as central banks. These financial guardians play a crucial role in national economies. They act as the banker's bank and the government's bank. Central banks are tasked with maintaining a stable financial system and a healthy economy. They are the architects of monetary policy, wielding tools to influence interest rates, inflation, and exchange rates. Central banks operate behind the scenes, but their decisions impact everyone. They determine how much it costs to borrow money, affecting businesses and individuals alike. Their actions influence the value of our savings and the prices we pay for goods and services. Understanding central banks is essential to grasping the dynamics of our increasingly interconnected global economy. These institutions are not merely technical entities, but powerful actors shaping the economic realities of nations and individuals. Central banks are entrusted with a critical mission, ensuring economic stability. Their mandate typically involves maintaining price stability, promoting full employment, and fostering sustainable economic growth. These objectives are often intertwined and require careful balancing. Price stability refers to keeping inflation under control. High inflation erodes the purchasing power of money, making it difficult for businesses to plan and for individuals to maintain their living standards. Full employment means maximizing the number of people who have jobs, reducing the economic and social costs of unemployment. Sustainable economic growth involves ensuring that the economy expands at a healthy pace without creating imbalances that could lead to financial crises. To achieve these objectives, central banks employ various monetary policy tools. They adjust interest rates to influence borrowing costs, impacting investment and spending. They manage the money supply by buying or selling government bonds, injecting or withdrawing liquidity from the financial system. Central banks also intervene in foreign exchange markets to stabilize their currencies, affecting the competitiveness of exports and imports. These tools are used strategically to navigate economic cycles, mitigating the impact of recessions and preventing excessive inflation. Central banks exhibit a range of ownership structures, reflecting the diverse institutional arrangements across countries. Some central banks are wholly owned by the government, while others have a mix of public and private ownership. In some cases, private banks may even have a controlling stake in the central bank. The ownership structure influences the degree of independence a central bank enjoys and its susceptibility to political pressure. The Bank of England, established in 1694, exemplifies a central bank that transitioned from private to public ownership. Initially, it operated as a private corporation with shareholders. Over time, the government gradually increased its stake, culminating in its nationalization in 1946. This shift reflects a broader trend of central banks evolving into public institutions as governments recognize the importance of monetary policy for national economic management. The Federal Reserve System, the Central Bank of the United States, presents a unique hybrid model. Established in 1913, the Fed comprises 12 regional Federal Reserve banks and a board of governors appointed by the President and confirmed by the Senate. This structure aims to balance centralized authority with regional representation. The regional reserve banks are owned by member banks in their respective districts, while the Board of Governors is a federal entity. This hybrid structure seeks to combine the expertise of private bankers with the oversight of public officials. The Fed's Board of Governors sets monetary policy for the entire country, aiming to achieve the dual mandate of price stability and maximum employment. The regional reserve banks implement these policies, providing financial services to banks and the government within their districts. The Fed's structure has evolved over time, reflecting the changing needs of the U.S. economy and the evolving understanding of monetary policy. The European Central Bank, or ECB, stands as a testament to monetary integration within a supranational entity. Established in 1998, the ECB is responsible for monetary policy for the Eurozone, a group of 20 European Union member states that have adopted the euro as their common currency. The ECB is governed by a governing council comprising the governors of the national central banks of the Eurozone countries and the members of the ECB's executive board. The ECB's primary objective is to maintain price stability within the Eurozone, aiming to keep inflation below but close to 2% over the medium term. The ECB sets interest rates for the euro, manages the euro's exchange rate, and holds foreign currency reserves. It also conducts open market operations, buying or selling bonds to influence the money supply. The ECB's creation marked a significant step in European integration, establishing a single monetary policy for a diverse group of countries. Section 6. Independence, a spectrum of control. Central bank independence refers to the degree to which a central bank can operate free from political interference. This independence is crucial for central banks to make impartial decisions based on economic considerations rather than short-term political expediency. Political pressure can lead to inflationary policies that benefit incumbent governments but harm the long-term health of the economy. The degree of independence varies widely across countries. Some central banks have a high degree of legal and operational independence, enshrined in their mandates and governance structures. Others are more susceptible to government influence, with their decisions subject to political approval or oversight. The level of independence often reflects a country's political system, its history of monetary stability, and the level of public trust in its institutions. Section 7. Regional variations tailoring independence. Central bank independence exhibits regional variations reflecting diverse political and economic contexts. In advanced economies, central banks tend to enjoy a higher degree of independence. This reflects a long history of institutional development, a strong commitment to price stability, and a consensus on the importance of shielding monetary policy from political cycles. In emerging markets and developing economies, central bank independence may be more constrained. Political considerations often play a greater role in monetary policy decisions, reflecting the challenges of economic development, the volatility of financial markets, and the limited capacity of institutions. The degree of independence in these regions often evolves over time as countries strengthen their institutions, build credibility in their monetary policies, and foster a culture of respect for central bank autonomy. Section 8. Impact on daily life. Feeling the effects. Central banks' decisions reverberate throughout our daily lives, impacting our financial well-being and economic opportunities. When central banks raise interest rates, borrowing money becomes more expensive. This affects businesses seeking loans for expansion and individuals taking out mortgages or car loans. Higher interest rates can also slow down economic growth, leading to job losses and reduced investment. Conversely, when central banks lower interest rates, borrowing becomes cheaper, stimulating economic activity. This can boost business investment, create jobs, and increase consumer spending. However, lower interest rates can also lead to inflation if demand outstrips supply. Central banks must carefully balance these competing forces to maintain a stable and growing economy. Section 9. Conclusion. Balancing control and freedom. Central banks stand as guardians of national economies, entrusted with the critical task of maintaining stability and fostering growth. Their ownership structures, degrees of independence, and policy tools vary across countries, reflecting diverse institutional arrangements and economic contexts. Understanding central banks is crucial for comprehending the dynamics of the global economy and the forces shaping our financial well-being. Central banks operate in a complex world, constantly adjusting their strategies to navigate economic cycles, manage financial risks, and promote sustainable growth. Their decisions impact everyone, from businesses seeking capital to individuals planning for retirement. As we navigate an increasingly interconnected global economy, understanding the role of central banks is essential for comprehending the forces shaping our financial lives and the delicate balance between economic control and freedom.